Hello everyone, welcome to today's US Open Live webinar. It is Thursday, March 16th, 13:20 GMT in our adjusted time in order to still start 10 minutes before Wall Street opens, given the time zone change in the United States over the weekend. This is your host, Nikos Tsabouras, Senior Market Specialist at FXCM, and what a week we are having. Just a few minutes ago, the European Central Bank stayed true to its intentions and raised rates by 50 basis points, offering no surprises. Of course, such a move was not a foregone conclusion given what we're seeing around the banking sector, as fears have spread also to Europe, and Credit Suisse has been in the eye of the storm, let's say. So we will talk about all of that today, but before we begin, as always, please read carefully through the disclaimers and the risk warnings, and then we will get the ball. Okay, let's get started. We can see here Euro USD is actually under pressure today. At this time, negative reaction, but limited to the ECB's rate decision, while we can see that tax is also under pressure. Now, as we said, let's put up Euro USD again in the forefront. As we said, the European Central Bank raised rates by 50 basis points as intended. It offered no forward guidance. And I'm just reading again, it's just a few minutes that we got the decision. I'm reading through some of the highlights of the policy statement. Inflation is projected to remain too high for too long. The bank also acknowledges an elevated level of uncertainty, and this reinforces the importance of this data-dependent approach around its policy path. The bank also says that it is monitoring current market tensions closely and stands ready to respond. It also says that the Euro banking sector is resilient with strong capital and liquidity positions. So that's pretty much it from some of the main things of the ECB decision. Just as a reminder, the previous time in February, the ECB had raised rates again by 50 basis points and had expressed intention to hike by the same amount this time, which it did. We had also seen hawkish commentary around its intentions past March for more tightening. However, this is probably all up in the air right now, given the banking crisis that started in the United States, but has also spilled over into Europe. When fear sets in, markets usually find the weakest link, and this weakest link in this case seems to be Credit Suisse. We have already talked about how this whole thing started with the closure of Silicon Valley Bank, and we had said that when there is a bank run, which was in the case of Silicon Valley, you never know how investors and depositors will react around other institutions. Now, pressure from Silicon Valley Bank moved over to regional banks, since the majors seems to be well capitalized and are definitely more resilient. Now, one of those regional banks that came under pressure was First Republic Bank, which was downgraded yesterday by Fitch. And yesterday we saw these concerns moving over to Europe and Credit Suisse. This seems to be the weakest links at this point. Let us remind you that Credit Suisse has been in trouble since the Archegos collapse losses of 2021 and had actually announced a restructuring plan late last year. Now, yesterday its stock plunged after Saudi National Bank ruled out increasing its stake in the firm. A day earlier, of course, Credit Suisse had talked of material weaknesses in controls over financial reporting, and this probably did not help its position. Now, in what was probably a late reaction, the Swiss National Bank said that Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks, and the fact of the matter is that it does seem to be well capitalized, and also said that if necessary, the S&B will provide liquidity to the travel bank. Now, today, the bank, let's say, took on S&B on the offer, tapped its liquidity to preemptively strengthen liquidity by intending to exercise its options to borrow from the Swiss National Bank up to 50 billion Swiss francs. So this seems to contain the situation a little bit, but again, we're still in the eye of the storm, and caution is needed. That's it from the latest developments around the banking, let's call it, crisis. Meanwhile, we have various other things going on, but they're trumped by these developments. I will stand on the geopolitical tensions which persist. The United States said that an unarmed drone crashed after an encounter with a Russian fighter jet, and we would say that it was quite of a harsh language there. While UK on the Sino-Western front, the United Kingdom banned TikTok, Chinese social media app TikTok, from government devices, not long after similar moves from the European Commission and the Biden administration in the United States. Now, let's now check what is going on with Euro USD. Again, we just had the decision of the European Central Bank. We expect the press conference by President Lagarde for more insights in around 20 minutes, in any case it will come after today's US Open, after the conclusion of today's session. We can see here that the reactions probably somewhat limited in the Euro USD, and the technical situation has not changed much, but again, we must stress that the technicals are on the background for now, as developments and news around the banking sector are what drives the market, and other news, of course, as well, such as the ECB decision. Now, really quickly for Euro USD, exposed to this critical region here around mid-1, of course, that we have highlighted again, has not changed much. Immediate bias is on the downside, and probably there is still room for more volatility, as we expect the press conference by President Lagarde. On the other hand, given that the bank has not offered forward guidance this time around, and these fears around the banking sector could contain it, its policy path, make it more reserved, there is risk for downside pressure for the euro. However, we can still see an effort to push forward, but it's hard to see moves above the daily Ichimoku cloud. A strong catalyst would be required for that. Now let's move over to US oil. Again, we need to be really cautious here, as we just had the ECB decision and the press conference is due in a little bit, around 15 minutes. Now let's move over to US oil. Once again, the same themes here around the banking sector and fears of recession and all that stuff weigh on the commodity. And on Wednesday, it dropped to the lowest level since late 2021. Furthermore, US stockpiles rose by 1.6 million barrels last week, and inventories are about 7% above the 5-year average for this time of year. Also, in its latest monthly report, the International Energy Agency maintained its growth forecast for 2 million barrels per day for 2023 after a series of upgrades. Now we have talked for a lot of time, and sorry, let's switch over to US oil. What we're viewing here is the DAX, which is under pressure but seems to have a limited reaction so far. This is US oil. Now, we had said that for a long time that sustained weakness below 70 was a tall order, but of course now those developments that we have changed that, and now there is a distinct possibility that we could see prolonged weakness below this region under which the commodity currently trades. US oil is now exposed to this region here, 62.41, 61.75. However, the move is overextended while Russian oil cuts this month potential for less aggressive hikes by central banks, and China's reopening can support the commodity and lead to a rebound towards, say, mid-72s, but does not inspire confidence in the current environment for it taking the 200 periods EMA around here in the mid-76s. That's it for US oil, and let's move over to the Nasdaq, as we are already 2 minutes into the US session. Now we can see that despite the fears around the banking sector, which started in the United States, the tech-heavy index remained resilient, as this crisis has led to repricing around the Fed's policy path. Markets now expect a more conservative approach by the central bank. At this time, CME's Fed Watch tool assigns the highest probability to a 25 basis points hike next week to 5%, which could also, based on this projection, could end up being the terminal rate. And rates are seen back to 4% by the end of the year. That's a complete reversal from what we had just a few days earlier. Now, the index has moved closer, has not changed much from what we discussed on Tuesday. The index has moved closer to this resistance region here at 12,430, 470, but we are still cautious for breaking above it, and more so for challenging 12,900, because the more conservative expectations around the Fed definitely help it, but we're struggling to see how this environment with fears around the banking sector can be supportive of Wall Street and the National 100. Given those factors, it is in a precarious position. You can see a return below the 200 period EMAs around here, 12,005 region, but a strong catalyst would be required for bigger losses that would tackle the 11,500 area. So that's it from today's developments. Again, we expect President Lagarde soon, ECB President Lagarde soon. Tomorrow we expect Eurozone February CPI inflation. Preliminary figures had shown that headline had ticked down to 8.5%, while core rose to 5.6% from 5.3% in January. Obviously, any news around the banking sector will be in focus. Next week starts subdued, let's say, in terms of economic releases, but things heat up later in the week. We will discuss about these things at our next session on Tuesday. That's it for me for today. Thank you for joining me.